battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name's Nick Stenger. We are Stenger Family Office. For the past 44 years, Stenger Family has made it our mission to deliver both clarity and confidence to help secure your financial future. Episode 189. We're going to jump right into it today and tell you what's going on with the markets. And don't go away. We've got some very special slides making an appearance. I put some charts together for the show today as well, so stick around for that. S&P here for this year, for 2025, is up about 3% now, after going down 20% in just a quick correction with the tariffs. And we told you this was going to be a fast turnaround. We didn't know exactly how quick it would be, but this was one of the fastest turnarounds we've had now since COVID. We told you this. And if you've been watching the show every week, we said this is going to be a buying opportunity for patient investors. We did the crystal ball episode. We said that markets were going to trade down in the short term. We're going to have a correction. You saw the S&P hit 4950, 5,000 points. That was a buying opportunity, 5,100, 5,200. And here you are today at S&P 6050. So where do we think markets are headed over the next 6 months, 8 months, for the rest of this year? We're actually starting to look into 2026 now, because we're getting early 2027 estimates on S&P profits. And remember, the market's always a discounting mechanism. So the market's always forward-looking about a year out, sometimes 9 months, sometimes 6 months out, but about a year out. We're going to look into the future and predict where we think things are headed. Now, the S&P is producing pretty strong profits. Remember, tariffs, yes, have come into play a bit, but a lot of tariffs are on pause right now. You've got this summer pause, and Besant is meeting with the Chinese folks in London, and we're going to figure out exactly where we fall with China on trade. And it looks like we're getting some successful deals out. We told you this was coming. Okay, so if you're surprised by any of this and you sold all your stocks at 5,000 on the S&P, that's on you, because we told you not to do that. We said that a trade deal was going to get put together. So here we are, and sure enough, you're going to start to see some deals. And by the way, I think S&P profits for second quarter this year, which are coming out very, very soon. Remember, that's April, May, June. We're almost to the end of June, if you can believe it. We're starting to get reports out in early July almost, where we're going to see what June profits were. And I think they're going to be a lot better than people expected. Then I think you're going to see Q3 profits be pretty good, maybe a little bit lighter. And then Q4 is usually a good time of the year to see profits go back up as well. So if we end this year with a forward-looking view of about 320, maybe 330 in profit on the S&P, I think you're trading the S&P right in that 63, 6,400 point zone. Now, we came into 2025 saying that the S&P could hit 6,700. That was going to take a little bit more PE expansion. You're going to have to get to about a 21 PE, and right now we're trading right around 20. So if we get a little bit of relief from the Fed, you saw this inflation report come out this morning, and it was a little bit better than people expected. We're tracking inflation now about 2.2, 2.3% year over year. Remember, the Fed has said that their target for inflation is about 2%. They may not get there exactly. I think pretty much what's going to happen is Powell's going to get to this 2.2, 2.5 range, and he's going to say, this is pretty good. This is pretty close to where we want to be, because the last thing he wants is to risk a major recession under his watch and have employment spike way up. Because you know what Trump's going to do. Trump is going to come out and say, hey, it's all your fault, Powell. You're the one who kept rates too high. Now, is there some truth to that? Should Trump be out there saying this stuff? Maybe, maybe not. You could debate it. Is Trump right, though, in a way? Have other places cut? Yes, they have. And Europe is cut. England is cut. We're starting to see cuts in Japan almost now. So I think there's a sense that interest rates are probably just a touch elevated. And if you get the 10-year Treasury back into that 4 to 5% range, that's a pretty nice trading range where it's at today. If you start getting maybe a half point cut on the short end, remember the Fed only influences the front end of the yield curve. If we can get yields back into that 4% zone rather than 4.5%, I think we're actually in really good shape. I think we could easily get the S&P up to 6,700. That's the big question, though. To get to 6,700, you're going to have just a little bit of relief on the inflation side of things, on the Fed's side of the equation. So remember the two equations of a stock's price. It's earnings times the PE ratio, the multiple we put on the future profits. And so in an an environment where rates are very elevated and inflation is high, we're going to trade stocks lower temporarily. But then on the back end, when rates start to come down, that's when the market is really going to front run expansion of PE. You're going to start to see stocks trade for 20, 21, 22, no problem. And that's where I think if you look into the future, you look at the crystal ball at the end of 2026, I believe we're going to get estimates in 2027 because we're already going to be looking a year ahead at $350 in profit. And so if we're at 350, basic math equation, 350 times 20 PE, you're at S&P 7,000 by the end of next year. So is it going to happen exactly like I just laid it out? Is it going to be to a T December 31st, we're at 7,000 next year? Probably not. We're going to have some bumps and bruises along the way. You're going to have some corrections. You're going to have some downside. You're going to have some scary stories. But it's just market math 101. And if you've tracked the math of the market now for the past 200 years, it's literally that simple. If a company makes more profit and it does better and it grows net income and it grows EPS, earnings per share, and it becomes a more valuable business over time, its stock price will go up. It's literally that simple. So just remember, like real estate, like gold and silver bars, like you see on Fox News, I get my gold bars from Roslyn Capital, just like you see all over the place. These are real assets. Stocks are a claim on real assets. Do not forget the fact that when you own Costco stock, you literally have a claim against Costco's balance sheet. So why in the world, when Mr. Market comes by and says Costco's worth 500 a share, it's about 1,000 right now, or Mr. Market says 750 or 800 a share, why in the world would you sell to Mr. Market at these ridiculous prices? You're going to hold your Costco stock and you're going to make your dividends and you're going to see net income go up and you're going to see Costco open new stores and grow its membership program and grow net income, and you are going to benefit from that over time. So even a zombie company, we've talked about these companies in the past, I won't name any names specifically, but even a zombie company, at a minimum, to stay in business has to go up at the rate of inflation. If you go back over 200 years, inflation's coming in and right around 3%. In some decades, it's about 3.5%. So to be a viable company 10 years from today, a stock has to go up 3.5% minimum to keep up with inflation. If you are a little bit better of a company, you're going to reduce some expenses. You're going to boost your EPS by maybe 1% to 2% on top of that every year. So your baseline for even a zombie company, as far as return is concerned, is about 5% per year. And then I think if you're a better managed company on top of that, where you're doing a stock buyback like Apple's done now the past 5 years, you're paying us a dividend, you're growing the dividend over time, add another 3 to 4% on top of that, and you've got a pretty easy, achievable equity rate of return over time of 8 to 9%. And the best companies are going to be 10 to 12%, especially if you're growing 20% a year like NVIDIA or some of these other names. So all that to say, don't lose sight of the fact that stocks are also math. And so the bond guys out there, the people that sell bond funds and individual bonds and all that, they like to say bonds are just math. That is true. Bonds are math driven, but stocks are math driven too. And so it's just not that straight line up to the right that we all would love to see. And so I've got a quick slide here for you, Producer O, if you don't mind throwing this up. This is S&P 500 index returns now since 2015. You saw about a 1.3% return in 2015. We went up almost 12% in 2016, 22% almost in 2017, followed by a small decline in 2018. Then you saw a face ripper, melt your face off year in 2019. You saw a great year in 2020 despite COVID. We told you to stay on your plan after a 30% decline in 2 weeks. Market actually finished up in 2020, 18.4%. We ended 2021 back-to-back triple years in a row. We had double-digit growth. We had 29% almost in 2021, followed by 2022 when the Fed started hiking. We were down 18% for the year. Nobody lost their mind and panicked then because the media didn't tell you to, like this time around. But the reality is we were down 18% in 2022. 2023, we were up 26%. Last year, almost 25%. And now this slide is just 2 days out of date. But we're up just over 3% now for 2025. And I think what this chart does a nice job of, the way we've set it up, is it shows you the stair step up over time. So it's not a straight line. You got 3 or 4 great years followed by a declining year. And why are we declining? Not necessarily because earnings are going down, going back to that two sides of the equation, earnings times price. But in a lot of these situations, you're just seeing the valuation on stock prices fluctuate. So that's why we watch like a hawk the multiples that we pay for companies in the portfolio. If you're a Stenger Family Office client, we've got 50, 60 different companies in the portfolio. We just want to make sure we don't have you in companies where we're paying 600 times earnings, 700 times earnings for a stock. Rather, what we want to do is just keep an eye on growth rates. And then are we paying a reasonable price for that growth? It doesn't matter if you find the best company on earth and you pay 600, 700 times earnings for it. 10 years later, if you paid the wrong price, you could still be down on that stock. And Cisco investors know this very, very well. So people who bought Cisco at the peak of the 90s literally have not broken even now 25 years later. Absolute insanity. You want to be very careful of that in the stock market. The other side of this, though, is also not getting into what's called a value trap. And we warn clients of this all the time. You may see a stock with a 9% dividend. Be careful. Sometimes the only reason you're going to get a 9% dividend is because the stock got cut in half, and now the 4% dividend or the 5% dividend has literally doubled, but it's not because the company's in better shape and it's paying you more in income. It's just a yield factor. And sometimes they cut the dividend. That's what happened to Walgreens investors who saw their dividends get slashed. And so be careful if you see a 9p stock or a 10p stock. Sometimes it's a good buy, but not always. You want to look at growth. You want to look at, is this company still healthy? One great example of a company that was very, very healthy, but just got traded off in 2022 was Meta. And you saw Meta go from $250 a share to $150 to literally 90 something at the bottom. And it was trading for 12 times earnings. We looked at it back then. We said, this thing is dirt cheap. And we bought it. Not that we've nailed every call perfectly for our clients, but so you get opportunities like that in the market where things are too cheap to ignore. And now Meta's trading just shy of about 700 a share. And it only took about 3 years. So you see these opportunities in stocks where if you have a basket of 50 to 60 companies, there's going to be a point where 2 or 3 or 4 of them are on a tremendous sale. And 5 or 6 or 7 of them have just run up way more than we expected their returns to be. And that's how you balance out your return over time. The biggest and the best companies, though, when you look at balance sheet quality, I think are going to continue to outperform. You've seen this massive difference, especially in 2024, 2025, between the biggest and best U.S. companies versus the mid caps and the small caps. Another thing that I want to point out, and this is another chart, producer, if you could throw this up on the screen, is year-to-date 2025 returns. Everybody's pointing out to the fact that, Nick, you always say international stocks are not a great investment. What about this year, 2025? You're exactly right. In 2025, we've been wrong on the international call. Europe's up 23%, China's up 16.5%, Japan's up almost 12%, emerging markets up 10%. This is as of June 9th. S&P right there, just around 3%. So it is true in 2025 that international is outperforming, but what you have to understand is nothing, in my opinion, has really fundamentally changed with a lot of the companies internationally. The big difference has been the currency. So you see the dollar weaken in 2025, and anytime you see the currency shift on you with international investing, you're going to see a pop in the short term. You saw this happen where a couple years back, you saw the yen spike way up and do very well. And Japanese stocks, if you took out the currency, really didn't do much. But if you put the currency back in, they did extremely well. You saw this with Europe a few years back. But it's such a sporadic thing that you see. Now, here's the next chart that I'll just show you. If you back out from just 2025, where yes, international is outperformed, look at the 3, 5, 10, and 15-year comparison between the U.S. and the blue there, Europe in orange, Japan in green, China in blue, in light blue, and emerging markets in purple. The U.S. has outperformed these other regions, and it's not even been close. Look at those 15-year numbers. Almost 2-1 against Europe. Look at the Chinese 5-year number, literally negative. Why do you think China came to the table and made a deal here with President Trump not too long ago, or is in the process of making a deal? Because they got absolutely obliterated in the last trade war. And we told you this. We said, watch out. China is going to get gutted. Companies are going to leave. They're going to realize we've got to diversify supply lines. And it shows up in the numbers. So you cannot like me for saying this or say, Nick, you just don't want to be in Chinese stocks or whatever. Well, hey, it's a communist country. And, sorry to say, if you would have invested in the Soviet Union in the height of the Cold War, I think you would have had the same results. You would have had the same experience. So I would rather be in U.S. companies where we got the rule of law, personal property rights, and then we're going into these international markets and selling our goods and services over there rather than having a place where President Xi just turns off the lights on you and now you're in a camp and nobody hears from you ever again. So to me, I mean, again, this is just my opinion. I think I'd rather be in the U.S. where we've got some of these protections, and it shows up in the numbers. You cannot debate these numbers. Now, let me show you one last chart before we wrap up, and then I've got one slide to show you as well. This is U.S. debt as a percentage of GDP. So a lot of people now are saying, Nick, aren't you worried about the U.S. debt? Aren't you worried about our exposure and how we pay over $1 trillion in interest? Yes, I am. I'm concerned about all those things. But relatively speaking, if you look at our balance sheet, if you look at our net assets as well, they are at record all-time highs, just like our debt is. The caveat here is during the 80s and the 90s, we still had about a 60% debt to GDP ratio. Now we're almost double that. In some years, we've been 125, 130%. We're coming back down a little bit, but we are going to have to see our assets grow a little bit more. Now, is this doom and gloom? Is this the end of the road for the U.S.? I would argue absolutely not. Japan has run these massive deficits for a very long time. They have had a much higher debt to GDP ratio, closer to the 220% zone compared to the US here at 120, 130. And Japan isn't out of business. Japan's still chugging along. Now, what's happened in Japan is growth rates have significantly slowed down. And that's the risk to investors in the long run is if most of your companies sell most of their goods in that country, you could have some significant weakness in growth. It's not that you go to zero. It's not that you completely fall apart and go into the Armageddon years like we've talked about, but you just run into slower growth. Now, Japan and its companies sell internationally. They don't just sell everything in Japan. So there's been this bifurcation of Japan's economy, which is stalled out. It's really weakened versus its actual companies. And this is why for investors, you do have to understand the difference between the economy and investing in companies. Yes, there's a connection to an extent, but over time, companies are going to chase growth rates. They're going to chase IRRs for their investors. And that's why you could have a slowdown in US GDP and not really have it affect companies the way you think it will. Now, of course, in the short term, you could have some bumps and bruises and the media will scare everybody off their plan. But for the most part, in the long run, Amazon is still going to produce Amazon Web Services. They're still going to sell 60 to 70% of that overseas. And then they're going to do all the heavy lifting of getting that money back to US dollars, which is a huge deal. You don't have to mess around with the currency hedge. So I still think the US is the best and last hope. I still think you want to be with our entrepreneurs here. And I think over time, even if the U.S. slows a little bit in growth, you're still going to see companies figure this out. I've been talking about this fact on the show now for a couple episodes, and I brought up Ecclesiastes to you, mentioning that because you don't know what the future holds, you should be excited. It seems backwards, and human nature is to say, well, I don't know what the future holds. The future's uncertain. Isn't that scary? And of course, that's our nature. But in reality, I think it's just the opposite. Because we don't know what the future holds, it's exciting. And this is why central planning doesn't work. This is why communism doesn't work, and Marxism and socialism is because if you just take 6 people in a room and tell them, okay, centrally plan the economy. Think about back to the horse and buggy days. If you put a bunch of communist people in a room and said, hey, let's figure out a better way for our to get around, they would have just tried to come up with a faster horse. They wouldn't have came out with a car like Henry Ford, and they wouldn't have came out with roads and bridges and all the things that entrepreneurs have invented over time. And they certainly wanted to come out with AI and machine learning and data centers and the cloud and high-speed computing and microchips and all the incredible technology that we benefit from today as investors. And I would tell you, over the next 5 years, over the next 10 years, you're going to be astounded at what kind of technology is coming down the pipe. Stuff that you've never heard of, never thought was possible. Companies and players in different industries that you never thought would be connected. One of the examples I gave last week was Constellation Energy, an old school utility company, which is now signing a 20-year deal. They inked a 20-year deal to provide data center power for Meta. And you would have, if I told you that 5 years ago, you would have thought I was out of my mind. Well, here's another one. And producer Rowe, if you don't mind throwing up this next slide. Amazon now is investing $20 billion of all places in Pennsylvania. It's not Silicon Valley. It's not the West Coast. It's not on the East Coast. It's Pennsylvania in the heartland of America. $20 billion to expand AI infrastructure. If I told you this 3 years ago, you would have laughed me out of the room. You would never have believed it. And so I'm telling you, 3 years from today, 5 years from today, 10 years from today, you're going to see more and more stories like this break. You're going to see more and more exciting innovations come down the pipe. And thank goodness we don't know what the future holds, because that's what makes it so exciting. We are going to see costs and input costs get reduced. Remember, entrepreneurs have this propensity to do more with less. So if you're worried about sustainability, if you're worried about natural resources, if you're worried about all the things that we're worried about, well, you should want entrepreneurs on the cutting edge of that. The story of the United States of capitalism, while it's not perfect, has been the fact that entrepreneurs have reduced costs, made life better for people all over the world. And I'm telling you, there's a reason you see lifeboats go across shark-infested waters from Cuba to try and get to Miami. You never see a lifeboat go the other way back to Cuba. At least I haven't so far. So if you find one, send it to me. But the reality for the U.S. and U.S. entrepreneurs is we are the shining hill on the city. This is where people want to be. And I think over time, our entrepreneurs are going to just be, they're just going to blow you away with what's coming down the pipeline. So stay invested, stay bullish, stay positive and optimistic. And it seems kind of silly sometimes to be an optimist when you see all the doom and gloom stories out there. But if you had one way to be, if you could only be bullish or bearish over the past 200 years, despite all the doom and gloom, despite all the negativity, you would have wanted to be a bull in the stock market. So I'll end it there, episode 189. Let me just remind you very quickly about Investor Day coming up soon. We've already got a bunch of people signed up on the pre-registration, and this is why you got to subscribe to the show. If you want to get the alerts and the updates and all the invites to the events before anybody else does, make sure you subscribe here on YouTube, Apple, or Spotify. You can actually scan this if you're watching on a computer. You can scan the QR code and sign up today. If you would like to also call in, you can call Katie the Greek. Her name is Katie Poulos, Katie.Poulos, Poulos, at StengerFamilyOffice.com. You can give us a call, 630-912-8295. Ask for Katie the Greek, and she will get you signed up for Investor Day. This is where we tell you exactly what we do with the portfolio, exactly what's going on behind the scenes here at Stenger Family Office to make sure that our clients are in the right investments over time. Thank you for being here. We're going to see you next time for episode 190.